This is Mastering Your Wealth with David Gagnon, the podcast.
You know, even with the stock market recovering from earlier swings, many Americans say retirement is feeling less certain, not exactly, more. So a survey by Live Career found that 9 out of 10 say inflation or market volatility has already changed their retirement plans. About 75% say they're delaying retirement altogether, as many pull from savings earlier than planned. So when inflation and market uncertainty start pushing retirement farther away, what should people focus on, David, and what mistakes should they avoid?
This is exactly what we're seeing in real life, not just in surveys. People aren't just reacting to numbers, they're reacting to the uncertainty. And that uncertainty leads to two major mistakes we see. They start making short-term decisions that hurt long-term plans. That's a big thing we see quite often. And they lose confidence in whether retirement is even possible. I saw this in a couple not too long ago. They had a solid plan. They had good savings, reasonable timeline. But once inflation spiked and markets became volatile, their mindset shifted from are we on track to should we delay everything? They didn't have the confidence in knowing whether they could live through that kind of cycle. So they started to pull back on their contributions. They weren't saving as much. They're holding on to more cash, and they were questioning whether their retirement date was appropriate because they wanted to retire sooner rather than later. And not because the plan was broke, but because their confidence was broke. So what we did was we reset the conversation about their retirement plans. And instead of focusing on the headlines, we focused on what really matters. So what people should focus on right now is income durability. Will it last through all kinds of cycles and for as long as you may live? Not just how much you have, but how reliable is that income going to be? Because you need a couple of things in the equation, in the mix. You need spending clarity. You need to know what your budget is for your necessities and your lifestyle spending, because lifestyle spending is going to be different for everybody. You'll likely have a bucket list of what you want to do in retirement. For a lot of people, it's traveling or spending time going on vacation with family members, doing things with the grandkids. And so we have to break it down to what's your essential spending and what's very flexible in your spending. And that flexible spending usually is your lifestyle component. And we have to have the time horizon aligned with your spending needs. And the short-term fear versus the long-term strategy, those are two different ways to approach planning. And we got to mitigate the fear component of spending. And we do that with planning. And the reason why people have so much fear in retirement and not spending comfortably is they don't have a clear, definable income distribution plan strategy. And so we always want to make sure there's protection against downside scenarios. If the market goes down, if you have a market-sensitive investment plan that you're relying on to create your income, you're already putting yourself in a very vulnerable situation. If early in retirement, your market-sensitive portfolio underperforms and you need to take that money to pay your bills. So volatility is very normal. It's not exceptional, but with a good plan, you can wade through that volatility because we're going to have income sources that don't rely on market volatility to make it work. And that's a key distinction of what people need to understand in retirement. In retirement, it's all about income. It's not about accumulating money anymore. It's a whole different objective. Types of mistakes that people should try to avoid is reacting emotionally to inflation headlines. We see this all the time. We hear about it. If inflation moves, your plan should be able to absorb it with good planning. Because what we're always going to do is stress test somebody's plan for different variables. And one of those variables is going to be higher inflation. And you don't want to raise your long-term savings too early. Sometimes people that have saved for future needs start to rob that money early because they had a bad experience and didn't plan appropriately in the short term of their market cycle. Not too long ago, we worked with a couple who pretty much had their mindset to retire. They had a sizable nest egg in retirement accounts, some in brokerage accounts. They ran their numbers, and they used a pretty low inflation factor of 2%. And we were in an environment at the time where inflation was, in fact, 4 to 5, 6% when we ran their numbers. And so what we did was we stress tested their plan based on a higher inflation factor, which they underestimated. And what we found was that they would be out of money if they couldn't sustain a long-term spending at that level of inflation of 4 to 5%. They'd be out of money right around their mid-80s. Mm-hmm. And they both had intended a very long life expectancy in retirement because both of their parents lived well into their 90s. And so what we did was we put together a strategic income distribution plan. We realigned their investments. So we restructured their plan with flexible income strategies, which is very important. We adjusted the withdrawal timing because timing and flexible income strategies, there are some advantages in doing that. We stress tested inflation scenarios, even at higher inflation factors. And they didn't delay the retirement. Once we did their plan and we strategically realigned their investments, they now became very confident that this would work because their money was in the right places. Because the way they were investing before, they were very vulnerable to market volatility to support their lifestyle spending needs and their actual bare bones needs. And so the real goal is to make sure that you run your numbers into the future using different variables that are stress testing, how it's going to look, higher taxes, possibly higher inflation, maybe an unexpected healthcare event where you have to pay for some expensive out-of-pocket healthcare. Is that going to be a factor that derails the whole plan? Because we always want to try to have a backup strategy for those unexpected events that may occur, maybe they won't. Out-of-pocket healthcare is derailing more retirements than I've ever seen.
Yeah, it's because the cost is just outrageous, and all signs point to it's going to get worse.
And we always talk about comprehensive planning, but you want to have a plan first before you even invest your money. Because how do you know you're putting your money in the right places based on what your personal objectives, financial objectives and goals might be? So, we're building your financial house. We're looking into the future with what you tell us you want to happen in your life in retirement today. And when there's a price tag to all that. And so when we run what people are currently doing with their own numbers and we factor in these variables, inflation and taxes, out-of-pocket health care, we'll see if it's going to work. Because, it's one thing to save your money. The other thing you need to know is what rate of return are you going to need on your money? And what is the ideal retirement age to make it all work based on how long you think you might live in retirement? There's so many variables that you'll never get it right, but we need to stress test the plan. But once we do that, we look into the future with what you're doing today. We'll see the problems that lie ahead. And one of them might be you may run out of money or you may run out of assets. You'll still always have some income because everybody is getting Social Security. But can you live on that Social Security alone? Some people end up in that position and then they have to sell their biggest asset at the time, which is their home, which may have a lot of equity. And I've seen this over and over again where people do sell this home because they have to. And then they go and live in an apartment and take the equity in their home and create some income from that and try to make the best of the rest of their retirement years. Now, if you do planning before this ever occurs, then we can have a high probability of avoiding that situation because we have a real plan. We look into the future with what you're doing today. We see the problems that lie ahead, and now we have time today to implement the right personal strategies and planning to make it work with a high degree of confidence and clarity, and that's what people need. And if you want to retire with confidence and clarity, give us a call. Let's have that discussion about what you're worried about, if in fact you do have a plan, and if not, what the benefits of a strategic plan might do for you in giving you that confidence to retire.
That confidence and clarity, folks. I mean, that is something that I think we're all looking for, especially as we get closer, if not when we enter retirement. As you mentioned here earlier, retirement is all about income, and income, right? And you have to make sure you're adjusting appropriately with a lot of moving factors, whether it's the cost of healthcare or market volatility or your risk in the market. These are all different things that you're going to be able to look at with David one-on-one. Again, if you'd like to have a conversation about having, that greater confidence and clarity moving into retirement, give us a call today. We'll do a stress test on that current portfolio for you. 203-872-0009. 203-872-0009. Of course, that website, masteringyourwealthradio.com. You know, we talk a lot about a tool called rebalancing, but what does it mean for your retirement portfolio? Here's Morningstar's Amy Arnott.
Rebalancing usually will involve selling assets that have gone up because they would be over your target levels and using those proceeds to buy into asset classes that have gone down. And why that can be difficult is sometimes if things are going up, people are reluctant to sell. And in fact, you could miss out on some gains if you sell for rebalancing purposes. So the purpose of rebalancing isn't necessarily to improve your returns, but really to control the risk level of your portfolio so that it doesn't drift too far away from your target levels.
All right, well, let's break this down a little bit, David. I mean, it's estimated that about 30% of those nearing retirement, they never rebalance their 401ks and IRAs. This can cause big problems, right?
Well, rebalancing sounds technical, right? But at its core, it's really about risk control. And the biggest danger is this. Your portfolio can quietly become something you never intended it to be. And I saw this with a client a while back. You know, he started with a balanced portfolio, and he didn't pay much attention to it. It was a mix of stocks and bonds and kind of a traditional allocation between those two asset classes. He had about 60% in his equity portion and 40% in his bond portfolio, and it was diversified between those two asset classes. So he started out with a balanced portfolio, but after a strong market run, and we've seen a strong market run for an extended period of years now. So his equities kept growing, and he never readjusted it. And so over time, his stock exposure increased significantly, and he didn't really pay attention to it. He didn't realize it, and so his risk level was much higher than his tolerance for risk. And he didn't feel it because the markets were going up at the time. And he didn't really understand it until we did a comprehensive investment portfolio analysis, which we do for our radio listeners. And what's great about that report, it really peels back the layers of all your investments that you're invested in. It gives us a good analysis of how much risk you're exposed to, what returns you might be getting, whether in fact you're diversified, and what fees you might be paying. And this becomes a real trap for a lot of people if they're not paying attention to their investments, especially after a good market run. And so what happens when you don't rebalance, risk will creep up silently, and you don't notice it until the markets drop. And losses will hit harder the closer you get to retirement, because that might change your retirement decision at a time where you're very vulnerable and you've lost the good value of your retirement portfolio that you were relying on to create that income when you do retire. And so when you're getting close to retirement, you have less time to recover. And then your diversification really has broken down for you. So here's where it becomes very dangerous. When a downturn hits, investors suddenly realize, I'm taking more risk than I thought. So then what do? They react. And usually when you react, it's at the wrong time.
I was just going to say, it's a panic. You hit that panic button.
Right. And how we handle this differently is rebalancing isn't just sell some winners and buy some losers. So it's about realigning your portfolio with your plan. And we just talked about having a plan first, and then identifying how your investments should be invested according to your plan needs. And so we look at risk tolerance versus actual exposure, the time horizon when you're going to need that income, your income need level adjusted for inflation and taxes and market conditions. And we rebalance intentionally, not mechanically. And so there's a process to making this all work very efficiently. So the goal is pretty simple. You should never discover your risk level during a downturn. You should already know it. And that's why you need to really have a better clarity as to how you're currently investing before the problems arise. Because if you're going to be in a reactive state of mind, it's usually at a point in time where something really bad has happened and your financial pain threshold has been reached to a point where now you want to do something different because something bad really happened. Well, if you wait that long, and we could have prevented that happening with good planning, then you wouldn't have to be in a reactive state of mind. We're trying to get people to be proactive. Reach out to us. Get this help we're providing to folks. Because we talk about all these issues all the time with people's finances, and it's because they're not doing planning. So if you want to be proactive and get better results with your planning instead of being reactive and deal with financial anxiety, give us a call. Let's have a discussion about how we can better help you with your planning objectives.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims-paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure of the ADV 2A Item 4 for additional information.